There are two challenges that traders typically face with liquidity. The first is knowing which level is actually being targeted, and the second is knowing whether the price is going to make a continuation or a reversal, which involves an understanding in advanced market structure, which most traders lack. So in this video, we've broken down everything you need to know about trading liquidity into 5 simple steps. So let's waste no time and start with step number 1, which is understanding the different forms of liquidity. Liquidity refers to areas in the chart that either contain a large quantity of unfilled orders or a large quantity of stop losses, and it presents itself in 2 different forms. When people typically talk about liquidity, they are usually referring to the external range liquidity, which can be either a previous swing high or a previous swing low. These are pivotal moments in the chart because they either result in a trend continuation or a trend reversal in the form of liquidity runs and liquidity sweeps, which we will be covering further into the video. The other form of liquidity is internal range liquidity, which is just another name for fair value gaps. This is what the price uses as fuel to attack the swing highs and lows. It's important that you pay attention to how the price interacts with both forms of liquidity, because together, they will tell you which direction the market is going to move. For our next step, we need to talk about order flow and how it can help us determine which liquidity level we should be targeting. When we look at a chart, the first thing we should do is look to see whether the current order flow is bullish or bearish. And this depends on whether the price is pushing through buy-side or sell-side liquidity, which can seem confusing at a glance. But we can simplify this through the use of 2 concepts, which are called break of structure and change of character. So let's see how they work. When a new swing forms on the chart, liquidity levels are created at the swing high and swing low. The liquidity level at the high is called the buy-side liquidity, and the liquidity level at the low is called the sell-side liquidity. For the context of break of structure and change of character, we look at which type of liquidity was ran through when this new swing was created, which in this case was a buy-side liquidity, which means we are currently in a bullish order flow. So with this in mind, our current break of structure level is the buy-side liquidity. This is because a break of structure refers to the level that would need to be broken through in order for the current market trend to continue, which in this case is an uptrend. And on the other hand, the current change of character level would be the sell-side liquidity. And this is because if this lower level was to be hit, it signals to us that the order flow might be looking to change, which in this case would be from a bullish order flow to a bearish order flow. But in this instance, the price pushes up and through the buy-side liquidity, which creates the break of structure, confirming that the uptrend is continuing. And now, with this new bullish swing, we have a new set of break of structure and change of character levels that we can use to assess if this uptrend will continue to progress. Here we have another depiction of a price swing, but this time, when we look at the liquidity that was broken before this swing was created, we can see it was a sell-side liquidity, which means that this chart would currently be in a bearish order flow. And this means that the current break of structure